What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be checking out Intel stock because the stock went up nearly 5% today after news came out that their CEO is retiring. And the surprising thing is, I was thinking he would be like 80 years old or something like that, but he's only in his 60s. He's not that old. So I was kind of surprised by that. But I can understand why investors are excited about this because this stock has not been, the company has not been performing, not just the stock, but the company has not been performing well these last couple of years. As you can see, the last 5 years, the stock price has trended downward big time. The stock used to be 60 plus dollars a share, and now it's really just been hanging out in the $20 range. If we look at the last couple of years of revenue for this company, we can see that since 2021, it has consistently gone down. They peaked at $79 billion of revenue, and now we're looking at near 54 billion. And then net income has taken a huge toll too. A couple of years ago, they were doing over $20 billion of net income. Last year, they did only 1.6 billion. And I think that's just because they have a lot of things going on, but I mean, Intel is just one of those players where they're losing market share. They're not keeping up with technology and innovation like other semiconductor chip players are. And so that's just what's going to happen. So, not great numbers there. You look at the cash to debt ratio, and it's almost twice as much debt as cash. So, that number is not getting any better. They cut their dividend, which is not a good, well, see, I mean, it's not a good sign, but it's a good move because it's probably going to help them out in the long run. So that's the good thing. Shares outstanding, not great. I mean, these last couple of years it's been going up, so not great there. And then we look at what analysts have them doing. We have negative EPS expected for this year, which is not good. And then next year it's going to go back to $1, which is what they did last year. And so you're paying 25 times earnings right now for a company that has no growth and has shown to have their numbers, their revenue and net income decrease the last couple of years. They're losing, sales growth is going down 3% this year, and then it's going to jump up 6%. I mean, I would be surprised if this company can just maintain their numbers. Like they're losing market share and they're losing money so quickly that I don't see why you'd want to pay 25 times earnings for this stock. I think it should be valued at like 10 times earnings. Like I think the stock should be $10. So I mean, when you look at the valuation, we can't look at PE because they lose money all the time. But price to sales, I mean, it's at historic lows. It looks like a cheap valuation, but the problem is the company is going downhill. And so, I mean, will a new CEO fix the problem? I don't know. It's possible, but I doubt it because this company is just, I don't know. They're just an old school company founded in 1968. And so I think we just have too many new innovative players that are taking market share. And so unless Intel, partners with somebody else or they do something crazy and make a big investment, I don't see how this stock would make a comeback anytime soon. And I just think it's overvalued right now, 25 times earnings for a company that is losing money and that is not growing but is shrinking. So that is my analysis for Intel. Thank you for watching, and I will see you in the next video.